Insurance has been a big issue for Californians. What's happening out there?
A lot of people think, well, insurance carriers are just multi-billion-dollar companies living the good life. That's not always the case. And it's in the last 3 to 5 years become we're losing so much money, we just can't do this anymore.
What people are going through now.
Fair plan might be your only option.
Can you tell us the cost? What was it before and then how much did it go up?
Our first year of fire insurance was $7,000 a year. The third year, it went up to $12,000, which we could no longer afford. We never imagined putting ourselves in a position where we would own a house without insurance.
Home insurance rates are skyrocketing in California because of fire insurance. Today, we're diving into California's ongoing insurance crisis. We'll explore why insurance companies are dropping policies, leaving homeowners with no options but the California Fair Plan, or going without insurance entirely. We also speak with state leaders about what California is doing about it.
The legislature is taking this issue very, very seriously. We are working hard on it, that we've designated at the highest levels of our own leadership.
What we're seeing is the cancellation of these insurance policies are not just for people in high fire threat areas. For heaven's sakes, I had my insurance policy canceled.
What will happen to your insurance rates? Let's find out together in this episode. I'm Siam Karami. Welcome to California Insider. Harry, it's great to have you on. Welcome.
Thank you very much. I appreciate you having me. It's my pleasure.
You know, insurance has been a big issue for Californians. In some cases, it's becoming impossible for people to get. The prices are going up significantly, or they have to go to a fair plan. Insurance companies are complaining that they're going out of business. And you're in the field of insurance. We want to talk to you about what's going on. What's happening out there?
It's a very interesting situation, and I've been in the business for a little over 40 years myself, and we've never been faced with such a situation either. And we are here for the consumers. So the agent is there to find the consumer the best protection at the best price they can. And if you go back, 3, 4, 5 years ago before this really started, we had lots of options. The consumer had a lot of options. We had automated rating software where we could take your information, plug it in, and find the best rate for your property, be it your home, your rental property, maybe a secondary residence that you vacation in. And then we would move that information to the carrier and transact the business, and everybody was happy. And that was with a lot of our major carriers, Mercury, Civil Service Employees, Travelers, Hartford, Safeco, all the big national players. Most recently, due to a lot of reasons, there is the regulatory climate in California, which is very pro-consumer, and that's a good thing. We have to have somebody watch out for the consumers also. It's there to help the carriers come up with the appropriate rates, and that just hadn't happened for over 3 years. Basically, after COVID, there was these long-term rate freezes where carriers started losing $1.15 to $1.25 per dollar they took in. And when you talk about multi-millions of dollars and billions of dollars, these losses just mounted substantially for carriers. Some of the small carriers, as you have to have regulatorily reserves for the amount of insurance that you write, those reserves would start to get hit with no way to replenish them. Some of your larger carriers were able to weather the storm. You saw most recently State Farm do a major announcement. We've never seen anything like that either, where they're backing off thousands of policies in the state of California for the same reason. You can only lose money for so long. So that's what's brought us to where we are today. There is options out there, but they're very expensive options. It gets into admitted, non-admitted products, like you said, the Fair Plan, and these other more expensive options in some cases. But then there is other cases where maybe if it's unaffordable for the consumer, or maybe you have a very, very large house in Malibu Canyon up in Northern California that's worth, Fair Plan will only write up to $3 million. If your home's worth $10 million, where do you get the other $7 million of coverage? So it's a very interesting and difficult situation, but we are hoping to see some light at the end of the tunnel.
What does it look like for you on the ground? We are hearing that as an agent, it must be very tough, right? You have to, do you decline customers? What happens?
So we never try and decline a customer ever. We actually try and find a solution, but it is very, very difficult today to find some of those solutions. Take, for example, I'm involved with 4 different agencies that I have ownership in. And in those 4 agencies over the last 2 years, we have faced over 2,200 non-renewals. So those are our customers that we
2,200.
That's just our agency. And we're a decent sized agency, but we're not the biggest. So you have agencies out there that are very, very large that have tens of thousands of non-renewals. You have agencies smaller than us with, hundreds of renewals. But when we get hit with 2,200 non-renewals, that affects our long-term customers. My grandfather was in this business, my father, myself, and my daughter's currently in the business. So we have 4 generations of families that we insure. And to have a family that's been with you 30, 40 years and you say, why are you canceling my insurance? And then we have to explain as agents, it's not us canceling your insurance, it's the carrier that we have you with. Well, wait a minute, you're my insurance. We're your insurance agent, so you have to explain that relationship because people have looked at our family and our agency for many, many years as their insurance, even though we're going through an insurance carrier. So we have to then really pound the pavement, really go out there and find admitted, non-admitted markets, or maybe you have a carrier. I just ran our statistics. We have been able to rewrite 75 to 80% of those policies, but the other 20 to 25% have had to find other options because we just don't have it available, or it's not priced at a position where they can handle that.
Is it usually because of the fire that they're getting non-renewals?
Believe it or not, yes, absolutely. Fire is a big part of it. Wildfire is a huge part of it. But also things like non-weather related water losses are really hitting our industry very hard. So someone's pipe breaks in their house on the 2nd story and it floods the house. People only think of devastating losses in the fire realm. Well, you have water losses. If someone's on vacation and a pipe breaks in their 2nd story and fills their 2nd story and their 1st story with water, that's just as devastating or as much damage as a fire loss. So we see a lot of water damage. There is a lot of liability issues going on in our state. You see all the advertisements every day for if you've had a loss at your home or you've tripped and fall or someone hit you in your car, call us, we'll help you. There's a lot of that going on here too. And there's so many losses related to property, auto, that affects the carrier because if a carrier writes home and auto and they have some commercial and they get hit in every line of business, you want to be diversified in this business. And because if you're losing money in one line, you can make it up in the other. But if all of a sudden we haven't been able to get rate in 3 years for the carriers, you are losing money on the auto book, you're losing money on the home book, and you're losing money on the commercial book, you've got nowhere to turn. So you got to pump the brakes. You have to back off writing new business. And you have to get your house in order from underwriting or rate.
So how does it look like for the consumers when they come to you guys? Do they not have options or is the prices are a lot higher?
It's interesting. I'm going to answer that in 2 ways. They do have some options in most cases. There is some extreme cases, like I talked about earlier, that are very, very difficult to do. Someone who's maybe had a lot of losses, fair plan might be your only option. And up to $3 million is all that you're going to be offered. That takes care of the majority of our property owners, but there's a lot of properties in California that are, valued higher than that. So that becomes difficult. And there's 2 things that have held carriers back from opening up and writing for our consumers. On the rating, there's more than 2, but 2 main ones. Every carrier in the state of California is responsible for a piece of the FAIR Plan if the FAIR Plan is not completely funded by premium. So if the FAIR Plan today, please don't hold me to these numbers, but I did hear them today, they're $300 to $400 billion in insurable value right now. That's not premium, but that's insurable value. So if we insure a house for $1 million, that's $1 million of the 400.
So they have done $400 billion of
risk.
Of risk taking on that they have to pay out if all of these people lose their home.
Yes. Now, fortunately, it's scattered throughout the state. So we may have a major event in Northern California or a major event in Southern California or Central California. We don't see the whole state burning up at one time. That would be catastrophic to everybody. But carriers have to pay their proportionate share of that loss So if you're State Farm, if you're Travelers, Mercury, Safeco, Hartford, you take your share of that loss, but you have no premium income to offset that. So you're accruing for that off to the side because and then on top of that, you're required to have reinsurance.
Essentially, what you're saying is the current carriers are on the hook for the FAIR plan if the FAIR plan kind of blows up.
That is correct. The FAIR plan is a private insurer. It is not a tax.
It's not a government.
There's no government money in that. So between the fund itself, the California FAIR Plan fund, and then the insurers,
what it collects itself.
It collects what it can, and it thinks it has adequate rates. But they just had an indication of over 50% rate needed. They filed for 40, and they got 15. So we're still 30, 40% underfunded. This really concerns the carriers because they're not able to charge for this, but yet it's a huge liability.
But the FAIR plan is very expensive already, right? Isn't it? I mean, to us, to the consumer, is very expensive, right?
Not in all cases. That's kind of a misnomer. In some cases, for fire insurance, and keep in mind, FAIR plan is for fire insurance only. They do commercial up to certain limits, and they do personal lines. But it's for fire coverage only. So if you look at the fire coverage piece by itself, in some cases, yes, it's very expensive. But what makes it more expensive is the other policies you have to buy to complete your portfolio. If you're buying FAIR plan for fire insurance alone, in some cases, it's reasonable. In other cases, it's not. So it's very difficult to say. It's always had the misnomer in the past of, if you have to go to FAIR plan, it's your last choice. You're going to pay through the teeth for that. It's going to be 3 times as much as your normal insurance. That's not always the case, but sometimes it is the case.
You were telling us about the reinsurance. Can you explain to us what it means to the average people?
Whenever a carrier sells an insurance policy to the consumer, they have to have reserves for a potential loss on that policy to a certain percentage, and then they buy reinsurance over the top of that. So let's take an example. And these are examples of numbers, but let's say we insure a $500,000 home. The carrier might take $100,000 or $150,000 of that $500,000, and then they reinsure the rest of that in the event they have a total loss. So let's say you have a portfolio.
So you essentially partially insure it, and then
that
you
is
pass
correct.
it to other people.
And when you buy the reinsurance, in case of a catastrophe or something else, you're not bankrupting an insurance company. So reinsurers sell reinsurance maybe all over the world and in all these different states. So they're very well diversified, they're very well financially backed, so that a carrier knows, okay, if I suffer a $1 billion loss in California, I'm reinsured for $750 million, I'm only losing $250 million. That's kind of the way it works. You have to have it. But in the past, carriers have not been able to charge for reinsurance or their FAIR plan accrual. You just couldn't do either one. That's why, and then you're already losing money on your day-to-day operations. I talked about that 1.25, anywhere from 1.15 to 1.25
they're bringing in, they're
for the
losing.
dollar, and you've got these risks out there, so they have to back off. They just don't have the capital to sustain that. So what the insurance commissioner has done is he's brought in what's called a sustainable insurance model that will allow for wildfire and risk-based premiums. So if you live in the mountains, you're going to pay more than someone that lives in the city because the risk is higher up here. So once that comes in, the carriers are starting to get a breath of fresh air and say, wow, if we can do this and we can get our right rates, we're going to be able to help solve this problem by coming back into the marketplace. And you'll hear me talk about capacity here in a minute. Carriers need capacity to open up, right? We got to make sure we can cover our losses. We got to make sure we can take care of FAIR plan. And once we get this done, we'll be able to open up and start taking policies in, of which then helps our consumers. And that's really what it's about.
And the reason that the insurance companies are not charging more, is it because for every dollar they take in, they're losing $1.25? There is a reason for the fact that they're not charging a little bit more, right? Can you tell us why is that?
The regulation in the state of California is some of the most strongest regulations in the United States for insurance. It's not the most, but it's up there. So when a carrier wants to raise rates, whether it's on auto, personal lines, commercial, you have to apply to the Department of Insurance with a full algorithm and all your reasonings why this rate is justified or why it's needed. A lot of people think, well, insurance carriers are just multi-billion-dollar companies living the good life. That's not always the case. And it's in the last 3 to 5 years become we're losing so much money, we just can't do this anymore. So that regulatory process takes a significant amount of time to get through. Like I said, you might have filed these rates a year ago. You just got approval, and now it takes a year to earn through it. So 2 years in, you're just now starting to get your rate. This new sustainable model will speed that up to 60 to 90 days for a rate approval. And then the consumer still has the right to intervene, which is a whole nother issue. Consumer watchdog groups can intervene if they think the rate is inappropriate. So if an intervener happens, then that is going to even take longer. So the regulation around getting rate is tough, but our state is working with the carriers to try and resolve that.
Harry, one of the things we are hearing from consumers, some consumers are going without insurance and they're risking it all. Can you tell us more about what your thoughts are on this?
My family has a fire service background and an insurance background. Both my grandfather, my father, myself, and my son were in the fire service, or my son currently is. So we've been on the ground firsthand to see what a wildfire can do, to see how devastating losing your home is at 3 o'clock in the morning and everything you own. And you know, the only good news you've had at that time is say, okay, let's get a hold of your insurance company. We're going to get the adjuster out here, and we're going to help you get through this process. That's a good feeling. If you have that same loss and you have somebody come up to you, which I've experienced personally both on the insurance side and the firefighting side, where someone has lost their home and said, I don't have any insurance. You know, what do I do? That's a really tragic situation. So, but you are right. We have both ends of the spectrum right now where you'll have someone that may get a rate and say, look, I just can't afford that. I'm going without insurance. If you have a loan on the property, you have to have insurance, so maybe your bank will force place insurance on you. So there's a little bit of protection there, but that's really only going to take care of your loan, not necessarily rebuilding your home if your fire occurs. On the other hand, you have some people that have enough wherewithal that will say, I'm not going to pay $10,000 or $20,000 for a homeowner's insurance policy. I'll take my chances. I'll put an alarm system in. I'll, make my house fire safe to the degree I can. I'm just not going to pay that kind of money. And if I burn down, I'll deal with it. But that's a very small portion of our population. We sit in the middle and say, property values in California are so significant. Everybody's got a $500,000 to $1 million home, and way up from there. We get really concerned when someone makes that financial decision to not protect themselves. And I'm not speaking from where I'm out there just trying to sell insurance as a salesperson. I will give people other references to other companies to try and get better rates, because I'd much rather see someone get insurance than go without, regardless of what I get out of it. It's not a good deal to go without some type of protection on probably the largest investment you have in your life. A lot of people are going what we call without coverage or going bare because of the cost. Cost is a significant factor. So let's say 3-4 years ago, let's take an average home of $500,000 to $700,000 of dwelling coverage. Say it was $1,100, $1,200 a year, maybe $800 or $900 a year. They were all reasonable prices. Today, that same policy can be $2,000 or $3,000, can be $4,000, can be $5,000. But historically, California has been very underpriced in the property market. I had a client last year, who's actually a family member, who had a beautiful home in Encinitas, California. It was a $900,000 home. They used to pay $1,300 a year in California. They sold their $900,000 home, they moved to Texas, and they bought another $900,000 home. That policy, the best rate we could get them, was $5,200 a year.
Wow.
So Nothing had changed. There was no losses, but you have a higher loss frequency in Texas than you did in Encinitas, but now California is catching up with those loss frequencies. So we've been historically, due to regulation and a lot of other reasons, significantly underpriced in what's needed to appropriately insure these properties, and now we're starting to catch up. It's very hard on the consumer, we understand, but we've also enjoyed artificially low rates for the last 15, 20 years, and now we're going to have to pay a little more for those coverages.
If I was somebody that got that notice in the mail about getting non-renewed, what would you recommend for me to do?
Use your phone.
Which is not a very good.
No,
very good.
Use your phone and use technology. There is a lot. I'm going to get to some real good news with that question. So we, in the last 4 months, have had 3 new pop-up carriers from venture capital groups, because there is money to be made in the California insurance market if it's done right and charged right. So you have admitted carriers that pay into the insurance guarantee fund in the state of California, and then you have non-admitted carriers that do not pay into the guarantee fund. So should something happen to a non-admitted carrier, it's not guaranteed like the other ones are. However, our non-admitted carriers are very, very well capitalized. They're very, very strong, and they're very, very large. Take like a Lloyd's of London that everybody knows. That's a non-admitted carrier, but it's one of the strongest insurers in the world. So non-admitted insurance used to be frowned upon a little bit. It's not now. It's part of the mainstream process. We've had 2 non-admitted homeowners products pop up. One is called Delos. Delos is a technology company that uses satellite imagery. They use modeling for fuel moisture. They look at your house. They don't just say, okay, this is your zip code. Let me look at this. You're going to give me your address. Delos hones in on your house. They look at your roof. They look at your surroundings. They say, well, he's got brush, but it's very high fuel moisture content. It's not going to burn, right? Because it's got a lot of moisture in it. So we can give you a rate.
So they're analyzing
your home.
behavior. So if you've cleaned up around your home, you get.
And so it's just like your driving record and auto insurance. The better driving record you have, the less you pay. If you got some challenges on your driving record, you pay a little more. So Delos has done a great job. Nobody is everything to everybody anymore, but they are writing a lot of policies. We have another company called Lightspeed that just got capacity, as I talked about before. So when these carriers come in, they go to the reinsurers, they go to the venture capital groups, and they say, how much capacity will you give us in California? Well, we'll give you $70 million. Okay, that means I can write up to $70 million worth of property under our guidelines and make some money at it. And those are starting to help the consumer, and we're able to now start placing some of those. Mercury has not shut down. They've had to back off. They've had to pump the brakes. They've had to look at underwriting a little harder, but they've never shut down, where other carriers have just flat stopped writing because they had to. But we're starting to see that open up.
Harry, do you have any other thoughts for our audience?
My grandfather and my father always taught me that you always do the right thing. If you put your customers and your companies first, this is my theory that I've developed over that story, and us as agents third, and you always act on that, you're going to be in a good position. You don't sell them the policy that makes you the money. You sell them the policy they need at the best price you can get it. And when they have a specific need, you go after that need. So if you put your consumers and your carriers first, you come third, but everybody wins. And you have a successful operation, and you can feel good when something happens that you've done the right thing for your consumer, for your customer, for the people that work with you. And we really try and live by that.
You mentioned that your grandfather was a firefighter and insurance broker. Then your father was a firefighter and insurance broker, and you were a firefighter and insurance broker. Can you tell us how all this happened?
Yeah, it's a very interesting story. So many, many years ago, my grandfather lost his father at a very young age, and he had 2 young brothers. So he needed to help support the family, and he needed a job with benefits. My grandpa was born and raised in the city of Pasadena. And so as he knew he needed this, he literally looked at the newspaper one day after the war, and Pasadena Fire Department was hiring. He said, well, I don't know anything about being a firefighter, but it's got benefits, it's a good job, it's got good pay, I'm going to go ahead and apply. So Grandpa applied and got the job. So he became the first firefighter in our family in the city of Pasadena. Firefighters in those days did not make enough money to get by, so you had to work on your days off. You had to have a second job. So he met a gentleman from CSE Insurance, or Civil Service Employees, who was starting an insurance company, came and said, hey, would you like to sell insurance on your days off? My grandpa said the same thing. I don't know anything about selling insurance, but he was doing construction, delivering ice, painting houses, anything he could to make an extra buck. So he goes, I'm gonna learn how to sell insurance because that's gotta be easier than what I'm doing now. So Grandpa learned the insurance business. My dad then became a firefighter in the 50s and got in the insurance business as a family-run business. In 1979, I became a firefighter as a third generation. This is all in Pasadena Fire Department, so it's been pretty exciting. And then got into the insurance business in the early 80s and really enjoyed it. Subsequently retired from the fire service to do insurance full-time. And then currently my daughter is the fourth generation in our insurance business as a family member, and my son is currently the fourth generation on the Pasadena Fire Department. So Grandpa started this all. He instilled in us, and my father, you know, you work hard, you do the right thing, and it will always pay off. And God rest his soul, he was right. You just work hard, do the right thing, and it's paid off. He started us on the road we're on. We just continued it, and hopefully it will continue for a few more generations.
Harry Crusberg, insurance broker and agent, it was great to have you on California Insider.
Thank you for having me. I really appreciate the opportunity.
As more carriers drop their policies, many homeowners are forced to rely on California Fair Plan, with some even having to forego insurance entirely. Michael and Christy Denew are among those who couldn't afford fire insurance for their home, which was recently destroyed by the park fire. Christy and Michael Denew, you guys are residents of Chico, and you recently lost your home and you didn't have insurance in the fires. Can you tell us your story?
We actually lost our first house that we purchased in the 2018 Camp Fire. After the 2018 Camp Fire, we moved just north of Chico, California, to a town called Cohasset, California, where we have been rebuilding our lives for the past 5.5 years until this recent fire, the park fire, came through and burnt our new house in Cohasset, California as well.
We're sorry to hear that. Now, did you guys have insurance, or was it hard to get home insurance for you guys?
So for the first few years, we had fire insurance, but after that, the insurance prices became so unattainable for us that we just could not afford it. It became such a great cost that we would have had a mortgage-sized payment just to have insurance.
Can you tell us the cost? How much did it go up?
So in Paradise, California, before the Camp Fire took our first home, we were paying $86 a month for our homeowners insurance. When we moved to Cohasset, California, our first year of fire insurance was $7,000 a year.
Wow.
And that was something we had to pay all at once, no monthly payment. Our second year of fire insurance was $10,000 a year. Again, we had to pay that all in a one lump sum. The third year, it went up to $12,000, which we could no longer afford. And they wanted us to pay $7,000 down for the first month, $4,000 for the following month, and then $1,000 for the third month to be able to afford it. They would not break it into yearly or monthly payments, I should say.
And what was it through the Fair Plan, or was it is it private?
Yes, the only insurance that would approve us was from the California Fair Plan, as well as we would have had to have a secondary insurance to cover everything that was not fire insurance. So flood, theft, everything else that follows your insurance plan would have had to been through a third-party insurance as well. So we would have had to double down on insurance to be able to have our house fully covered.
And you decided to not take it on, right? Is that what you guys did?
We really wanted to. We never imagined putting ourselves in a position where we would own a house without insurance, seeing how we'd already been through a fire and lost our house in a fire before. But it just became so much money to where we did not have the $12,000 down to be able to afford the insurance. It was just too unobtainable for us. So we've been doing quite a few interviews over the past few weeks to try to raise awareness of how hard it is for people here in California, through the whole state, who do not live in city areas, anybody in a rural area or flood zone or fire zone. It's just becoming so hard for everybody to be able to afford insurance, to where unless you're stuck to somewhere with traditional insurance, it's a real issue. It's hard for people, the common person, to be able to fathom paying almost a mortgage amount payment to be able to afford insurance, which is something that you absolutely need when you're a homeowner. And it's getting worse and worse. My understanding is 17 to 22% a year is the increase on the California Fair Plan, which just does not seem fair to the people.
What happened? You lost your home in the current park fire. Can you tell us, so you can't get anything, right? Is that you lost everything essentially?
That is correct. Currently, the only thing we have is our income, as well as any donations people are giving us, and that's pretty much it. We're practically rebuilding our lives from the ground up. We went from being homeowners, owning our house outright, to now having literally just some clothes and a few personal possessions.
Well, we hope that you get enough donations and hope that you can recover soon. And there is a lot of Californians that are in your position, where they are risking everything because they can't afford home insurance.
Mm-hmm. Correct.
Best of luck to you. We hope that soon you'll get enough donations and support from the community, and you'll rebuild everything and you build a better home.
Thank you. We really appreciate that.
So how did California end up in this insurance crisis? To find out, we sit down with Senator Bill Dodd, who has been working closely with the legislatures and insurers to tackle the issue for the past few years. So Bill, it's great to have you on. Welcome.
Thank you very much. Thanks for having me.
Can you tell us what's happening? You're an insider. You've been looking at the state policies.
Yeah, I've been looking at this very, very closely now for about the last 7 years. And essentially what's happened over time is we do not, this is stating the obvious, have a stable insurance market. And in order to have a stable insurance market, you have to have insurers that are willing to come into a marketplace and compete with other insurers. That simply isn't happening because the fact of the matter is the insurance companies, particularly with inflation and all the fires that we've had and the demand surge that we've had for building materials and labor here in the state of California, the costs have just gone up the chart. And the insurance companies do not believe at the current rates that they're able to write policies and be able to make money. And after all, this is a for-profit business. But essentially what we've been trying to do is we've been trying to work both sides of this problem. One, prior to 2017, the state of California wasn't doing anything on wildfire prevention. No reduction of fuels, no prescribed fires. We didn't really have a great Air Force to try to early point attacks on these fires. And so over time, what we've been doing is almost spending from zero to about $1 billion a year on wildfire prevention. And these programs are working. We're working with Firewise programs, communities all over the state of California. The locals are doing a great job as well. And of course, we've been spending over the years an average of $3 billion on wildfire suppression. So that's putting out the wildfires with all CAL FIRE. But since then, we've bolstered up, and I think we have 69 major aircraft, night vision helicopters, the big jets that drop the retardants on the fires on the early point of attack. So I think we are doing a much better job in that area. But what we've been focusing on, and the governor has been focusing on, and the insurance commissioner, is the rate side of it. we've had Prop 103 in the state of California now since about 1987. And while that has helped, it has also created other problems as well.
So this proposition was to cap the rate increases, right, for the insurance provider?
Yeah, Prop 103 did that because at the time, it was mostly for auto rates. We were about 20% higher than anywhere in the country. And of course, we have the biggest insurance market of any state in this country. And I think that some groups wanted to push back on that. And that was the proposition that created the insurance commissioner, the insurance commissioner's office, and rate reviews, not only of auto policies, but of homeowner policies as well. And so there's a whole process that if you can't, if an insurance company wants to increase its homeowners rates by any more than 7%, then it would have to go through an intervener process. Well, over time, actually, Prop 103 worked. We have the lowest, if you can believe this even today, short of, if you've had your policy for a long time, our rates in the state of California, let's just say pre-2017, were some of the lowest insurance rates in the country. Well, you can kind of see that we really don't have a balance there, because where is California the lowest rate of anything, anywhere
We're usually the
in the
most
country?
expensive
We are the
state.
most expensive. So we have to find that balance. And so this intervener process would allow, if an insurance company came with a rate increase higher than 7%, these interveners would come in and work on behalf of the people of the state of California. And as a result, some of these rate increases were taking 2 years to put forward. And so we kind of see this dichotomy where you would have rate increases of 7%. Well, you would have to have 4 or 5 years of 7% rate increases for an insurance company to come back to this particular market. So our whole system just kind of, we kind of felt like it was trying to do the right things, but it was broken. Fast forward to where we are today, without getting, some people with the FAIR plan, they're paying 4 times what they were paying before. Some insurance companies like Lloyd's of London or Chubb are charging anywhere between 4 and 10 times what a homeowner would have to have paid before. And what we're seeing is the cancellation of these insurance policies are not just for people in high fire threat areas. For heaven's sakes, I live kind of in the north middle of Napa Valley, nowhere near the fire areas any longer. I was there at 2017, but no longer there. And I had my insurance policy canceled. So rates are going up everywhere anyway. If we could do this in a more controlled manner, the way the governor and the insurance commissioner are pushing forward, I think that is it is a very, very positive thing. A couple other things, and then I can kind of fill in at your pleasure. But we've never been able to, the insurance companies have never been able to model based on climate models, catastrophic models. They could only model on historical models their rates. Well, there's no real history with climate change yet. I mean, we're starting to build history. So historical modeling for rates is not the way to go, and they're working on that as we speak. The other thing is insurance companies have never been able to price in reinsurance in their models, and that has been a disservice to the ratepayers in the state of California. That's changing. And the final leg to the three-legged stool, so to speak, is they are fast-tracking rate increases as we speak so that insurance companies can increase their rates, let's say 25, 30%, 35%. I think Allstate had a rate increase. But let's face it, 35% rate increases across the board are a heck of a lot better than cancellation of policies or rates that are 3 to 4 to 10 times more than they're paying right now.
We have heard that there are insurance companies that are regulated by California, and they have very low prices, and they're essentially losing money, or they're in trouble. And then there are other insurance companies from outside of California that can come and insure people, but they're not regulated.
Right.
And they don't have to follow the rules that we have. What are your thoughts on that? Is this true?
That is absolutely true. Those companies are doing like Chubb and Lloyd's of London and those bigger worldwide type of insurance companies are in the unadmitted market. So they're not regularly doing business and registered to do business in the state of California. That doesn't mean that they can't, but it just means they're not an active participant in the California market. Without them coming in, there would probably be so many. Frankly, there are a lot of people out there with no coverage whatsoever because they just can't afford it.
Wow.
But there's a lot of risk out there that have been taken up by these companies in the unadmitted marketplace. And so it is confusing. But on one hand, if you force them to come into the admitted market, all they would do is say, sorry, I'm not going to do business in the state of California.
And then there is also the FAIR plan, which people have to go. It's the insurance of the last resort. And as you mentioned, it's like sometimes 5 times to 10 times the price, right, of what people are getting.
That's right. And the number of policies in the FAIR plan has more than doubled over the last year. This is a critical problem. It's got way too many clients to really withstand the type of risk that it is. No insurance company would be allowed, frankly, to do business in the state of California. Yet this is where we're at today. And one of the reasons why insurance companies in the admitted markets are trying to lower their market share in the state of California is because they're required to make up the losses if there is a big conflagration. Let's just say kind of down closer to where you are from, down in Southern California, Lake Arrowhead, where, God forbid, to have a conflagration, big, huge fire. The potential losses there could be $5 to $7 billion. That would break the FAIR plan, but who would have to cover that are all the insurance companies in the admitted market.
So even though the insurance companies are dropping these insurance coverages and sending them to FAIR plan, they're still kind of on the hook for the losses,
for the
right?
FAIR plan, yes. And that's why the whole program that we have in the state of California, with the governor's been working hard on, and the insurance commissioner and the legislature, is trying to bolster up the insurance industry so that we can get them quicker rate increases, bigger rate increases, reinsurance, catastrophic modeling, and on top of it, do the things we're doing on the prevention side so that we can create a stable market and start having them pick up all these customers in the FAIR plan and bring them back into the fold and insure them so we can lower the risk on the FAIR plan, lower rates, increased rates to be sure, but lower rates than the FAIR plan from all these insurance companies in the admitted market.
So it's based on what you're saying, consumers essentially have to pay more, but it's a matter of how much more and would their insurance get dropped. What do you think is the number that consumers should expect? Is it 20%, 30%, 40%? Where is it?
I think, and this is just a good guess, I would say somewhere between 25 and 40%. And I know people in the Napa Valley, in the Sonoma Valley, Solano County, Yolo County that I represent that would love to pay 40% more for the same coverage they had, early on. That at least is affordable, it's doable, and ultimately creates a more stable insurance market and perhaps competition over time that could bring those prices down.
Now, for some of the consumers that may have bought a home and they have done the math, calculated what they can pay, and if they go without insurance, what are your thoughts on that? You mentioned some people are going without insurance.
Well, that's a personal decision, that could leave them with absolutely nothing. We're kind of working, this is really totally unofficial. One of my colleagues, Senator Cortese from Santa Clara, is talking about, if not 100% insurance, is there a possibility of getting 40% insurance so that people, until this thing is really fully cooked. And I'm thinking we're about a year away, could be a little bit longer from a stable insurance market. But is there a way that people can get some insurance at some level? to go through and if you live like I'll use the example of Lake Arrowhead, or another example to the north, Lake Tahoe, having no insurance is very risky, and that's a personal decision. If you can't afford it, you can't afford it, and all you can do is hope and pray. And hope and prayers are not a great strategy, but sometimes if that's all you've got. The other side of the problem is if you've got a loan on that, you could lose your loan and that house could be foreclosed on. There are not a lot of good options.
Now, do you have any other thoughts for our audience?
I guess, in the same thing, hope is not a great strategy. I do have hope, though, and I think that just as as somebody that has so many neighbors and constituents that are going through this, these issues, I see light at the end of the tunnel. I knock on wood, which is not another great strategy again, but nevertheless, we've got to keep our eye on the ball and continue to fight these things, and we get through at the end of this year and continue to streamline rate increases, give these insurers the rate increases they need, make sure that they have the reinsurance, make sure they have catastrophic modeling, and continue to reduce fuels, because that reduction of fuels is like painting the Golden Gate Bridge. You start at one side, you finish, go all the way to the other end and finish. Well, guess what? You have to go back and start all over again because of the corrosion of the salt air and everything else. Well, because of rain and droughts and everything, all that foliage grows back, and we've got to continually be on it. And that's not for a 1 year, a 5 year, a 10 year. This is for our lifetimes as we know it. We've got to continue these programs.
Senator Bill Dodd, it was great to have you on California Insider.
Thank you very much. Thanks for having me.
We also sit down with Senator Dave Cortese, who's another key policymaker working to address the insurance crisis from the legislative side, with a focus on innovative approaches like partial insurance coverage. Dave, it's great to have you on. Welcome.
No, thank you very much. I'm happy to be here.
You have had some ideas. One of them was partial insurance, like for homeowners to get some level of insurance. Can you tell us more about this?
Well, that's an idea under discussion and really a little bit of a challenge, I think, to some of the insurance industry that's basically saying they cannot underwrite anything in California because of the risk going forward. So I think what has happened is the mentality from the insurance risk side has become, well, if we could lose everything in a given community, then how could we partially insure? But I think it's a little bit of a fallacy because not every community in California is subject to that kind of risk. We have urban areas, of course, where most of the population is densely populated. Certainly, we have areas in my home county here in San Jose and Santa Clara County that are wildlife interface, but we have lots of areas, massive amounts of areas that are in the heart of the cities, just San Jose and the 14 other cities, that presumably could be underwritten to some degree. And I think that's where, sort of this kind of idea or concept of partial insurance really is also framed in a question, well, how much can you insure? If you can't say zero because there's not 100% risk of everything burning down in California. If you can't take the risk that you were taking as an insurer, what can you take on? Is it, it's very much like for the people who are familiar with, who have ever financed a home or familiar with a mortgage, or even a life insurance policy for that much, there's always a value ratio, right? Normally there's a value ratio. With real estate, it's called a loan to value ratio. And some of us are just asking the insurers, give us a number. If you can only insure partial value in the city of San Jose because we have a lot of, fire damage going on right now that's unaddressed, give us that number. It just shouldn't be zero. So that's one thing that's going on in terms of the conversation. We're trying to bring out legislation on board that.
So the idea is essentially homeowners would go to the insurance provider, and the insurance provider would maybe insure half of the value of the property or whatever. Is this the idea?
Yeah, that is the concept. The concept, I think, when you start talking about partial insurance, is how much of the value, the overall value, can you cover as an insurance company, without bankrupting yourself as an insurance company in case there is a loss. And we want to delve into that a little bit more deeply. There's also other bills that I think you'll see coming forward, and some of them as soon as the next couple of weeks, that are going to try to do things to make the insurance process work better, especially for homes, and especially in light of this fire resilience issue, this fire risk issue. For example, we can authorize bills that reward homeowners for hardening and for creating defensible space around their homes, and then turn back to insurers and say, now that we've done that, we've reduced your risk, can you underwrite insurance on those homes now? And then lastly, just as an example of what's going on, Fair Plan, you mentioned that at the beginning, and with Fair Plan, that was really a group which is not state owned, but it was authorized by the state to be sort of a backup system when people could not get insurance anywhere else, whether it be a condominium or a house or a small development. They could go to Fair Plan if nobody else would insure them. Well, now that insurers are getting out of so many communities, Fair Plan has been inundated with not only applications, but it's overpopulated now, based on the kind of resources they have to pay off claims. So we know right now that Fair Plan has taken on so much new business that with a couple of major losses, it would literally become insolvent. So one of the things we're going to have to do as a legislature, I believe, is allow for bonding authority, the state's bonding authority, which is, of course, sort of the way the state borrows money, to be available almost like a credit line to Fair Plan, so that if they get an excessive number of claims, that the homeowners themselves won't be left holding the bag. In other words, Fair Plan won't be able to tell them, sorry, we ran out of money. They could say, sorry, we're running out of money, but we're going to get the money we need from the state of California under this new legislation so that we can pay out the claims on the properties that we've covered. So these are things that we're working on. We do need to start reducing the insured population in Fair Plan. It's already too big, but that's simply as a result of people flocking to Fair Plan because they couldn't get insurance anywhere else right now.
Is it possible for reducing the Fair Plan? Is it possible for those people that had to go to Fair Plan to come back to their normal providers?
Yeah, it'll be possible for consumers to come back to other providers, whether it's the carrier, whether it's the insurance company they had coverage with before, or maybe a different one. That's what we want to have happen. We don't want Fair Plan, gobbling up much more business because they don't have the assets long term to cover that. That was not the way they were designed. So we actually need that to happen, what you just described. We need people to go back to ordinary private insurers, whether that's State Farm or Allstate or whoever. But first, we have to get those private insurers comfortable with the underwriting quality and the underwriting risk in California right now. And that's why we're trying with this new Senate insurance group, and there's an Assembly insurance group also in the other house. But we are working hard together in the legislature with special study groups around insurance to try to get this work done as soon as possible, and then start having that business shift back naturally to where it should be.
Do you have any other thoughts for our audience?
I want the audience to know that the legislature is taking this issue very, very seriously. I want the audience to know that we are working hard on it, that we've designated at the highest levels of our own leadership in the state Senate and the state Assembly, key legislative members like myself to work on this issue to break through. We know that people who have invested their entire lives, their life savings in their homes and their properties can't be left at risk without insurance coverage. The whole economy is built on this idea that private insurance coverage will be available. And we believe it's up to the state to step in and to help create the environment in California where consumers can be protected, but insurance companies can still receive fair premiums and a reasonable return on their investment as well. So it's a balance that we have to strike, and it's important. We're out of equilibrium right now. The insurance companies can't afford to insure right now because they can't get new rate approvals from the Department of Insurance fast enough to allow them to write coverage. We're trying to speed that all up. We're trying to do some of these other things that I talked about, again, to create an environment where insurers feel like they can get reasonable rate increases approved, but consumers don't feel gouged at the same time. That's the balance, and that's the trick. That's what we're trying to get accomplished.
Senator Dave Cortese, we hope that you soon find a good solution for Californians. It was great to have you on California Insider.
Thank you very much. It was great to be here, and I appreciate the invitation.
We hope you enjoyed this episode. Make sure to let us know what your thoughts are on the insurance crisis in California. And don't forget to send us your stories. You can always reach out to me at siamak@californiainsider.com. We read every one of your emails. Thank you.